Take a seat.
They will see significant slowdown. They may have positive growth, but it will be accompanied by a lot of financial and other shocks that will make things very, very difficult for policymakers. Indonesia, I think, is teetering on the brink. The banks, particularly the smaller banks, are facing liquidity problems, very severe ones, and the risks of bank failure are rising by the day. Policy leaders seem to be paralyzed in the face of that, and I think the rate cut last night might have been a mistake in that context. And then you have other vulnerable economies like Thailand, where political crisis reduces the resilience of what should be actually a fairly resilient economy. Now, that's the bad news. What about the post-crisis world? In the post-crisis world, at first blush, it might look like not a nice place for Asia, because clearly, with the cost of capital going to be higher, because liquidity is going to be tighter, with cost of energy probably higher, despite the recent fall in oil prices, with geopolitical difficulties increasing and therefore diverting resources to military and unproductive uses, unlike the last decade and a half, clearly global GDP growth will be lower. Secondly, with more, I think, inevitably some restrictions on global trade, with higher transportation costs, I think global trade, which is critical for Asia, will not grow as dynamically as it did in the past. And I think the financial landscape, in terms of the institutions that comprise the key parts of the financial world, the composition of the financial landscape, all this will change. Now, Asia will have to respond to this, but I'm quite confident that it will actually help us do the things that we should be doing anyway. First of all, boosting domestic demand by various means. Secondly, building up stronger financial institutions. One of the problems we have today is you have a problem in New York, and then the global asset allocator tells this fund, okay, you got to cut your risk. So he goes to Asia and starts taking all his money out of Asia. Asset prices start falling, currencies start falling, then you create a problem in our part of the world. Now, if we had strong financial institutions that invested in our own markets, then we're not so vulnerable to foreign capital exiting our markets. So we need to address this vulnerability by building up our own capacity in financial funds management and the like. And I think what it also shows is that we need to get a lot more serious about regional integration. Now, you notice there's a lot of rhetoric about Chiang Mai Initiative, but when Indonesia is in crisis today, does it even think of the Chiang Mai Initiative? It's completely irrelevant. And we should ask ourselves why all these wonderful rhetorical advances in regional integration did not produce anything of material support to countries like Indonesia and the rest during a crisis. If these things can be addressed, and I think they will be, then I think Asia will be fine post-crisis. So let me stop here. Thank you.
Thank you, Manu, for that gloomy message. Remarkably, nobody left the room. They even applauded you. Really, the sobering words for those of us who thought that things can't get much worse. I hope you're wrong, but I fear you may be right. Let me now hand over to Hak to focus on Singapore.
I thought I'd just echo Manu's message, because I guess our global chats have also released the forecast for next year. And it looks like very much a global recession is the central scenario. In fact, they're looking at the US contracting 1.5%, Europe 1.4%, and in Japan by 1.2%. So essentially, I guess 60% of the world will be in recession next year. That doesn't help. That'll be the slowest global growth, I think, since 81-82 recession. So that's going to be pretty painful for Singapore. I think there's two negative feedback loops at work that's emphasized. I'll just highlight them here. Is that asset values have really collapsed dramatically, such that I think U.S. personal savings behavior will change quite a bit. In fact, as the housing prices have collapsed by 22% in the U.S., and our U.S. chaps are not expecting it to bottom until the end of next year. So they're looking at about 33% correction from the peak. That's about 5 trillion destruction in housing asset values. Stock markets, as you know, worldwide has also collapsed. Stock markets have collapsed now about 0.5% globally from the peak. That's about 25% trillion in terms of destruction. That's about 40% of global GDP. So there's a substantial change there. And as you know, personal savings rate in the US before this was pretty much just below 1%. That's clearly not sustainable, and that's why there'll be an adjustment probably to about 5% over the next few years. That means a sharp pullback in consumer spending, which I think will affect Asia. I think the second point is that there is also a big structural adjustment in the financial sector, as Manu highlighted. The IMF itself estimates the write-downs for the banking sector of $1.5 trillion. You see the amount of capital raising from the private sector and governments in the tune of $900 billion. So we're basically only about 60% through. And of course, the financial sector has to shrink. Regulators will be a lot more stringent about the capital requirements, and there will be a pullback in balance sheet. Financial institutions themselves are hoarding liquidity just to survive current recession. And assets themselves have become a lot more risky. So I think there's less appetite for a lot of risky assets. So this could mean quite a big hit as well in the financial sector. And Singapore, I think, being offshore, a big financial center in Asia, cannot escape from that. That's sort of the backdrop for Singapore. I guess just some key points here. Well, I think Singapore was the first basically in Asia to basically slip into a technical recession. I think we felt it much earlier than the other guys. We felt it as early as second quarter, April, May, where we started seeing manufacturing and exports started contracting already. And of course, since the beginning of this year, we also start seeing the high-end residential prices correct quite a bit. So we were hit on both sides. And then come June, July, our tourist numbers started getting worse as well. Those numbers started contracting. We were surprised to see Malaysians, Indonesians, even from China, all coming off quite sharply. And that contraction has basically broadened out. I guess what's worrying is that we are expecting Singapore to continue to be in a recession all the way up to second quarter of next year. That would probably put it in about 4 negative quarters. That will be in line with the worst that Singapore has seen. Singapore has only seen 4 negative quarters in 85, 86, as well as the tech bust. Surprisingly, Asian crisis, we only saw 3 negative year-on-year quarters. So there is some hope in the sense that hopefully 6 to 7 months' time we'll be out of this. That's in line with the worst magnitudes. Of course, we can argue that this time it's different. This time it could be much more severe, as Manu highlighted. One point is that this is a global recession. Therefore, it makes it much harder for Singapore to export itself out. In fact, when you look back at the previous recessions, one of the glimmers of hope was that when exports started improving for Singapore, the bear market in the stocks ended, essentially. But it's hard to see ourselves exporting ourselves out for 2 reasons. The fact that the rest of the world is in trouble. And the second point is the exchange rate for Sing dollar hasn't really gone down as much. When we look at the previous episodes, the correction in the Sing dollar was much more substantial. Which is also one of the views why we think the Sing dollar has a further weakening to go, probably to about 160, 165 in about 6 months' time. I think second point is that we ask ourselves, are we going to get it? Are we going to be hit as bad in terms of the stock market's economy as the Asian crisis? Because if you believe that we are hit, stock markets have basically here fallen, for example, beyond the trough valuation seen for the tech bust and SARS. But if you believe we are hit as bad as the Asian crisis, where stock markets collapsed to about 0.7 times price to book, then you're talking about 1,200 STI value. You're talking a substantial 30-40% fall further in the correction of the stock market. And some of the scenarios highlighted is that the crisis is moving closer to the neighborhood. So far, we've actually been okay. It's the G3 slowing. It's Taiwan, it's Hong Kong in a recession. But Indonesia and Malaysia was holding up quite well over the last 3-4 months, until the last 2-3 months, with the collapse in commodity prices. And the consensus forecast for the neighborhood around Singapore may be rather optimistic, given what has happened. In fact, we've recently seen sort of figures out of Malaysia, for example, on the manufacturing side, they started contracting. Exports figures for yesterday started contracting, which was a bit of a surprise. But it shows that it is not too hard to imagine our neighborhood also falling into a recession, which also questions whether Singapore can hold up and might suffer another leg down.
Take a seat.